3, 2, 1.
You're listening to Rocket Your Dollar, where the finance gurus who created Rocket Dollar explain all things self-directed investing and how to achieve financial independence. To learn more about how to open a self-directed IRA, visit rocketdollar.com. Now let's get started with the show.
Welcome everyone to Rocket Your Dollar, the podcast from your friends at Rocket Dollar. In the show, we discuss the power of self-directed investing. My name is Thomas Young, co-founder of Rocket Dollar. Thanks for joining us, and let's jump in. In this episode, I'll discuss why you haven't heard of these accounts, why it's not in the best interest of the big providers to let you know about the options that you can take outside of their funds that they sell you, and why it makes so much sense for everyone to be investing at least a portion of their portfolio outside of the stock market. A little bit of reference before we dig into it. The landscape in private investing is really changing, and before it was all about access to deals and accreditation, which means that you need at least $1 million net worth outside of your primary residence, or depending on your marital status, you have different income streams. And the second part of that is the deal flow, which is you need to have access to these sort of investments. And it's not like Yahoo Finance where you can just go in and look at different stocks and look at their historical performance. You need to know someone that knows someone in order to be able to get into the investment, whether it's a real estate syndicate, a startup, a VC fund. It's just not easy to get into these things, especially if you don't live in what we would call a investment hotspot. Historically, Silicon Valley, San Francisco, New York, Austin, Boston. So if you live in middle America and you want to make a private investment, it wasn't really easy, and it wasn't really easy to qualify. So that's changing today. And for those of us that want to make investments through a self-directed account, it wasn't easy to set one of these up. It was time-consuming. It was painful. You had to go to your lawyer, most likely, and they would charge you a couple $1,000s to set up a plan, and then likely another couple $1,000s a year to maintain it for you. So it was just kind of a perfect storm of people not being able to access their largest pool of money, most times, accreditation, and the fact that deal flow is difficult to come by. So this is all changing, thankfully, and we'll dig into a little bit of each point in today's episode. But the big thing to keep in mind is that things are changing, access is growing, and the entire investment landscape is really becoming more friendly to smaller check sizes and more deal flow. Let's dive into why you haven't heard of a self-directed account and why they haven't been marketed to the masses. And the first topic we want to dig into is the immaturity of the investment space as a whole. And what do we mean by the immaturity of the space? Well, like we touched on a little bit earlier, it wasn't always easy to get into these sort of investments, and there wasn't a lot of deal flow, which means that people weren't really motivated to look outside of what they could access, the stock market. And as crowdfunding and crowdlending and different digital platforms become more mainstream, people want to get in on these deals, and their retirement accounts are their largest pool of funds. So it just makes sense for people to start looking for alternative things that they can do inside of their retirement accounts. They're tired of being stuck in stocks, bonds, and mutual funds. So we really want to dig into what's changed and what allowed people to take advantage of some of these alternative investments, getting around the accreditation question and the deal flow question. And it really comes down to digital platforms providing access and the Jobs Act. So let's dig into a little bit about the Jobs Act. So on April 5th, 2012, the Jumpstart Our Business Startups Jobs Act was signed into law by President Barack Obama. And what that allowed companies to do specifically is raise money, a certain amount, from unaccredited investors, which then let platforms such as GoFundMe and MicroVentures and all of these different platforms that we can now invest in startups, it basically paved the way for them to be able to establish themselves as companies and start feeding money into startups from unaccredited investors. So one of the things that's really happened is that this is such a new space that people are only starting to scratch the surface, both companies as entities raising money, but also investors looking to place dollars. It's never been easier to take advantage of these opportunities. And right now in 2019, we're sitting at this point where people do want to take advantage of these things. They're seeing the returns that people are getting. It's exciting. It's the next Apple could be sitting on your screen while you have a cup of coffee in the morning, and people want to take advantage of these things. And so as they start to research and as they start to make these investments, it's only natural that they want to accelerate their investing with their largest pool of funds that's sitting in a retirement account. The problem is that it wasn't easy, and that's why we're here, is to make that access easy. So, for example, the mutual fund has been around since the 1920s, but they didn't really explode in popularity until the 80s and 90s when people started realizing the powerful returns that mutual funds were having. There was a big bull market, and it became the standard for diversification was taking advantage not of a couple stocks, but of a pool of stocks, and it worked really well. But that model is changing a little bit. So it's just a natural time for people to shift their focus and really start looking outside of things like stocks, bonds, and mutual funds. And it's the new wave of investing, and it's alternative. So how do we know that self-directed accounts aren't well known because of the immaturity of the space and because of the big providers, as opposed to people just not using them because they aren't that great? And it comes down to a few things. One of my favorite stories about Roth IRAs and self-directed IRAs is that in 2010, Max Levchin, who was one of the founding board members of Yelp, who we all know and love, exercised his rights to his shares of Yelp through a Roth IRA. And when Yelp went public at a stock price of around $22, which it's around where it's trading now, that means that the value of his shares inside of a Roth IRA, which he will never pay taxes on, is about $95 million, and could be a lot more. We don't really know the extent of his account. So when you are able to get into these alternative deals that have basically unlimited upside, it makes this account really exciting because of the potential. We know what the market's going to do. It's going to go up or down 10 or 15%, hopefully, steadily up, but we know we don't have unlimited upside. And one of the things that's really exciting with these accounts is that you can carve out a piece and take a big risk and take a big bet. And if it pays off, it could be a life-changing event that then you don't have to pay taxes on. So, it's not that these accounts aren't great, or it's not that they're not powerful. It's that they're just expensive historically, and access has been really limited to people that had the connections to the people that knew how to set them up. So now that we've talked a little bit about the immaturity of the alternative investing space and how it's gotten a lot easier for the average investor to invest in cool things that they care about, let's talk about the people that get no rewards for you having this account. And that really comes down to the big banks. The investment banks don't have an incentive to tell you about self-directed accounts or to set one up for you because of the way they make money. And they don't make money by setting up the account that you buy with them or charging you a monthly fee. They make money on the products that they let you buy with their IRAs or 401ks. When you buy a mutual fund, there's fees associated with that fund. And a lot of the times they're hidden, they're shady, you don't know exactly what you're paying for. So if a bank is making money on the products that they're selling you inside of the IRA, they have no incentive to sell you an IRA in which you can invest in things like real estate or startups because they don't have a way to monetize that. And as long as big banks and big providers make money on the brokerage side, they have no incentive to offer you any product that they don't own and they don't sell you. So how do self-directed providers like Rocket Dollar make money? It's completely flipped the model of the big banks in that we charge money to set up the account, to actually go through the process of funding it for you, making sure that it's compliant, and then turning back control to you, and then a small monthly fee. In our case, some people charge yearly, some people charge by asset, but it's really much more transparent. The entire space, I can speak for ourselves, but also for different providers, you know what you're paying for. And Rocket Dollar, we don't make any money on the investments you make, how much money you make from those investments, or the number of transactions. We very upfront charge $15 a month, and that's how it fits into our business model. Okay, so where does that leave us? We've talked about why people haven't been actively looking for these accounts because of the immaturity of the self-directed space and the incentives that banks don't have to allow you to get into these accounts. So where does that leave us? We talked a little bit about the immaturity of the self-directed space and why people haven't been actively looking to make investments. And we talked about why banks have no incentive to tell you about these accounts, much less set them up for you. And that really leads us to our third point. And because it was difficult to do, the space was immature, there was a very limited number of people that wanted to do this, which made it difficult and time-consuming to get these accounts because there was only a few people that really knew how to set them up. And so if there's not a huge amount of demand, these products are obviously going to be expensive and they're obviously going to be time-consuming because they're not being opened very often. And so that's really what is changing today. People want to get in on these sort of things. They want to make these investments. And that's really the opportunity that Rocket Dollar is pursuing, is making it easy and accessible for everyday investors, no matter whether it's a $10,000 account or a $500,000 account, to be able to take advantage of the investments that are popping up. So as we dig into our third topic, there's one thing that's abundantly clear. And if you're not a big, huge time investor like the Warren Buffetts of the world, you're not going to go out and pay a CPA or an attorney thousands of dollars to figure out how to set this account up for you. And that's even if they know how to set it up or if they can research it. So it was just a very manual process. You probably had to drive down to your attorney's office. You had to pay them their hourly fee. They were going to charge you thousands of dollars to present to you a bunch of paperwork that then you had to figure out how to manage. And you were still kind of operating in a gray area, and you didn't know if you were compliant. You didn't know if it was right. You didn't know if it was wrong. You had no guidance on whether something was an allowed transaction or a prohibited transaction, and not even digging into how hard it was to track the outcomes of some of these things. So you didn't even know if you were getting your money's worth on setting up this account. So what's changed since the heavy paper days? There's a few things that have changed. One is, thankfully, the government has gotten a little more digitized with how easy it is to file an LLC, have an IRS EIN number. Basically, the nuts and bolts of setting up an account has become easier and cheaper to do now that states are finally online. Took them a while, but we're there. So to recap a little bit about what we've talked today and why it's the perfect storm, sort of say, for self-directed investing. The one big one is that the average person can access private investments even if they aren't accredited, thanks to the Jobs Act. 2, Rocket Dollar and our competitors are making it easy and inexpensive for anybody to open a self-directed account. Even if Charles Schwab makes it difficult, there's this new crop of providers that want to make this easy for everybody. And the third one is that because the government has gone online and it makes it easy to establish all of the legal entities that go into one of these accounts, providers like Rocket Dollar are able to drop our prices and really pass the value on to the end user because it's not taking us days and months to set these accounts up. We can do it inside of 30 days, have your account funded, and you can take advantage of the opportunities that we touched on earlier. Thank you for listening to this episode of Rocket Your Dollar. If you enjoyed this episode, please subscribe and share the podcast with your friends. To learn more about self-directed investing or to get started with your own account, please visit us at rocketdollar.com. And like always, thank you to Capital Factory and the Austinpreneur podcast for sharing their recording space with us. See you next week.